Time now for ETF Friday. And we now have newer gold ETFs with differentiated characteristics that may eventually take on the well-known gold ETF GLD. Here to talk more about it is James Seyffart here of Bloomberg Intelligence. And James, talk to us about these newer ETFs, because when I think about a gold ETF, it is simply that spider ETF GLD.
Yeah, everyone thinks about GLD. So a lot of these newer ETFs are coming out with differentiated characteristics. So one of them is cheaper, obviously. In the ETF world, the fee war is going on. You can lower a basis point and money is flowing into there by the billions. In the gold space, we have functionality that's coming out. So the best look at this is AAAU, a ticker that just launched, and it takes advantage of 3 or 4 of these new characteristics. So one of the things it will do is it'll store the gold differently than the way most traditional ETFs will store the gold. So it'll store it in Australia. Most ETFs stored in London, which is where most of the metals trading goes on. Another aspect they offer is doorstep delivery. So if you have enough shares for a fee, you can actually have gold, an equivalent amount to the shares that you own, delivered to your doorstep. And the last one, which is the newest, that no other ETF offers, that it's backed by the Australian government. So there's a guarantee on the gold being held in this ETF.
So sticking or returning back to GLD, the price is well off the highs back in 2011, 2012. You have a really interesting observations. If we hop into the Bloomberg and take a look at a chart that you prepared relative to the GLD flows, also compared to the price of GLD. And here is that chart. Can you talk to us about what makes this so interesting?
Yeah, so GLD back in 2011, 2012, like you mentioned, had over $80 billion in assets, one of the largest ETFs. Now it sits around $29 billion.
Wow.
A lot of that is outflows, but even more of that is from the price of gold. As you can see over here, the price has gone down a decent amount since then. But what we've noticed with the flows is that as the price of gold goes up, money goes in, and as the price of gold goes down, money leaves. So there's a strong correlation there. This is the opposite that we see in like the crude oil ETF market, and largely we think that's because gold ETFs, predominantly the assets are in spot traded, or they're actually holding physical gold. There's no way to do that in the ETF market in the energy sector. You can't hold a spot oil ETF. So a lot of it's accessed through futures and derivatives, which opens you up to contango and backwardation. So traders are using it for hedging, and you see the opposite. As the price of oil goes up, flows leave, and that's how it works.